Welcome to the Mr. R Show, presented by the MRR Institute. This podcast is designed specifically for tax professionals looking to scale and modernize their practice by maximizing revenue through resources. Join us as we explore expert strategies, innovative tools, and actionable advice to help you navigate the evolving landscape of the tax industry. Whether you're aiming to grow your business or enhance your client experience, you're in the right place. Now, let's get to the show and transform your practice together.
Hey everybody, and welcome back to the Mr. R Show here, presented by the MRR Institute. And today, I know this is a topic because me and Chris Picuro, who I will introduce him back to his own show here momentarily, we got to kind of keep him in a corner sometimes. We don't let him out right out of the gate, but we eventually let him into the race. So we've been at these events. So I'd say over the past really 3 months, me and him have been traveling really north and south, going to a lot of tax professional conferences, anywhere from the Michigan Association of CPAs over to, actually I should say down to Orlando for Taxposium through NATP. All great events. I think there was a couple more in there. And it always seems like this topic comes up. So we're going to focus a little bit on cost segs, but then obviously there's a little bit more to it as well. We obviously brought out a fantastic guest, and no, I'm not talking about Chris here. We got to, we don't want to give him a big head. He already lost his hair, the poor guy. The last thing he needs is to obviously have a big head. He can't fit through the door. But without further ado, Chris Picuro, welcome back, sir.
Gosh, with that introduction, said we don't do this show once a week. Thanks, John. It's great to be back. And you and I have been had the fortune of being able to attend multiple conferences over the summer. And it's funny, we presented to a variety of groups, each in about tax planning. One was a short-term rental loophole explained. One was tax planning masterclass on how to monetize a tax return. The one thing that was in each of these presentations when we would talk about case studies is the concept of a cost segregation study. And I think the cost segregation study is the lowest hanging fruit for any real estate investor when it comes to tax planning and strategy. Now, we do talk a lot about ideas are cheap and implementation is valuable. And there's a lot of bad eggs out there, bad apples, eggs and apples. I don't know. They both could be bad. But I could just speak from personal experience in our private CPA practice. Our guests today I've been working with for multiple years, and they do an amazing job in making sure that our clients legally and ethically get the best result possible when doing a cost segregation study. So on today's episode, the listeners, we know you're tax professionals out there, although we always say just because you get paid doesn't make you a pro. What I want from you is to keep an open mind, to understand that none of us know everything. My niche is real estate, so I deal with about 100 cost segregation studies, one way or another, or proposed ones a year. So we want you to be able to identify when you think you have a client that could benefit from a cost segregation study and the benefits of working with a partner. Because ultimately, if for some reason they don't benefit, that's okay. You were the one that brought it to their attention. Then we're going to find out also timing of the cost segregation studies, and we're just going to talk through real examples. So without further ado, and I'm so excited to introduce Heidi Henderson from Engineer Tax Service. Welcome to the Mr. R Show.
Thanks, Chris. I always love joining you and John. You guys are amazing and have been wonderful partners for the last few years. And, this is such a fun topic. I agree. It's the low-hanging fruit, and it's one that we still see is missed more often than I can fathom at times. I'll tell you one really quick story before we dive in. This used to happen all the time, but I had a client, it's been a while. I had a client I was talking to the other day, last week, I think, and he had somewhere his buddy had told him about cost seg. His buddy has real estate. He has real estate. He says, you're doing cost seg on your properties, right? And he's like, what? I never heard of it. And long story short, the guy calls me. We're having a conversation about it. He says, well, I'm just I'm a little bit unclear because I talked to my CPA and my CPA said, no, you can't do that. That's illegal. And I was like, oh, But, we'd love to have a conversation and be happy to share all of the IRS guidance and the guidelines as to what this is. And that the phenomenal thing is the audit guidelines actually say in them that applying cost segregation converts to the preferable method of depreciation. So actually, it is the proper way to do it. But the IRS just says, look, we're not going to force you to have to go out and pay for a study. So if you don't want to, fine, take your standard deduction, your loss. And that's the funny thing. So I just had to start off with that, there are still tax preparers out there and bookkeepers and accountants that don't understand the value. And it really does undermine the relationship with clients in the end. So fun topic, and I can't wait to dive in.
Yeah, heck, if the IRS has ever given a green light for something, it sounds like that might have been it right there.
Well, I mean, as a tax professional, in my opinion, it's our obligation to do what's best for clients. And this strategy is probably my favorite, top 5 for sure, because there's so much flexibility to it. And I can't wait to talk about that. But Heidi, can you start by talking, obviously our audience is, and you've been an amazing guest on our sister podcast, Teaching Tax Flow, which is for taxpayers. This one's obviously for tax professionals. Can you give the listening audience a 30,000 foot view of what a cost segregation is?
Yeah, absolutely. I'll give you my little rundown. I try to make it as simple as possible. What I tell taxpayers is it's very similar to whether you take a standard deduction or you itemize your deductions. I tell my kids, when my kids were really young, and they're 18, 19, 20, and they were starting to they were independent finally, filed their own tax return, take a standard deduction, it's fine. But as you get a little bit more mature or you have some business activities, obviously, if you itemize, you may have a much larger deduction. The caveat is you have to have some support. You have to keep your receipts. You have to document what are those costs? How did I come up with this? Because the onus is on the taxpayer, right? It's their responsibility to be able to show those things. Cost segregation is providing an alternate method of depreciation and using makers instead of straight line. So the straight line depreciation, commercial property is over 39 years, or for residential, 27 and a half years. When we shift to the maker's method, it's the accelerated class recovery system. That is, again, actually the preferable method for depreciating real estate, because we're actually going in and creating an itemized deduction to look at every single component of the building, everything that was inside. We're not just simply making the assumption that a client bought asset A. It is this, we'll use a rental home as an example, asset A for $400,000, and now we're going to depreciate that over 27 and a half years. That's your standard deduction. But the cost seg is going in and saying, well, we know that carpet, it shouldn't be depreciated for 27 years. I mean, if it lasts 27 years, that's just gross. So first off, we need to look at actual useful life for the assets that this taxpayer just acquired. That's why it's the preferable method, because when we look at that, well, we know that they bought a dishwasher and a refrigerator and multiple other appliances, probably some carpeting and some fixtures, a number of things in that property that will fail and have to be replaced over a shorter period of time. Therefore, the cost segregation is going to go in and define the value of every single piece of that acquisition and then put it in its appropriate and correct useful life category. That then allows the taxpayer to take a faster accelerated deduction, as well as then qualify for bonus depreciation, which is applying to everything shorter than 20-year useful lives. So nothing building related, but everything that's personal property or land improvements all fall into that bonus depreciation category. So really the benefit in the first year with bonus is so significant that the benefits to the client are really dramatic and is well supported by the IRS as well.
Well, and that's the thing is, I know with Tax Cuts and Jobs Act, which we're going to jump into in a little while, because of bonus depreciation, cost segregation studies got to be so popular, but ultimately we've been using these studies for over a decade because, especially on commercial property, instead of writing it off or deducting it over 39 years. And yeah, that's a great way to look at it is ultimately when you purchase real estate, there's personal property located in that real estate. And you have to do something in an IRS compliant fashion to break that portion out to get to accelerate the depreciation for those asset classes. And then the bonus depreciation has just been the cherry on top of it, really.
Exactly. That's what I've said. It's like we got a steroid injection. I mean, the concept of cost segregation, it's actually been around for over 30 years. It's been applicable, widely used, even by the big four firms on large commercial projects. One of the things that we've still seen carry through the accounting industry is the older concept that cost segregation is very expensive. And second, that it really is only beneficial on very large commercial properties, large hotels, giant skyrise multifamily buildings. And that used to be the case. That's exactly why our founder started this company 25 years ago. He was working for a big four firm. And he says, wow, these taxpayers and investors are able to apply this strategy that is so significant in terms of reducing their income tax liability and helping them then increase their wealth and their generational wealth and their personal portfolio. Why can't we just do the same thing? Let's create a boutique firm and we'll serve small to mid-sized clients. Because if we do that, we have that same expertise. So we started to pull people out of big four firms that were doing this work, taking it to the marketplace where we could apply the same strategy. And to your point, bonus depreciation essentially gave it a steroid injection because what happened is over time in the market, we've seen, as with all things, this digital transformation. We're seeing technology, we're seeing innovation and automation. There are some dangers to that because I think we all are exploring where's the middle ground between still having high-level white glove service, doing something correctly, I love your phrase, legally, ethically, and looking at the data, but still being able to use efficiencies where we can to keep the price points reasonable so that it's applicable for all taxpayers. That is really, that coupled with bonus depreciation is what has shifted the market to making it applicable to even single-family homes, short-term rental properties for every taxpayer out there that's buying a small investment property. It still makes sense to utilize this type of study, whereas 4 or 5 years ago, we would have said, yeah, once you get to $1 million, $1.5 million, maybe $2 million, that's when it makes sense. Now that's out
right.
the
And
window
when we think about
because
it,
we're really seeing it
we know
applicable
that
on all
residential
property
types
is and almost every
27.5 year life and commercial's 39. And we do know that we get a step up in cost basis upon death. However, think about how much depreciation deduction is never taken because a taxpayer passes away. I mean, it's amazing. So cost segregation studies, what they're doing is they're breaking out the personal use portion of real estate and anything Tax Cuts and Jobs Act and beyond that breakout is eligible for bonus depreciation. Excuse me. What are some of the major asset classes that you're seeing now? I know you mentioned previously it was $1 million plus properties, but I would imagine a lot of short-term rental property owners, and then we can start talking about, because the cost segregation study actually accelerates the depreciation deduction. And then for some taxpayers, they could take that deduction immediately, or they can offset income for the next 5 to 7 years, which are both really nice benefits. But yeah, so what are some of the asset classes that you're seeing the most right now?
Oh, yeah. This is a fun conversation.
Mm-hmm. Oh,
I
yes.
always ask people, so have you noticed there's a new car wash on every corner in your town? Well, guess why? So, bonus depreciation, I guess we back up a little bit. The IRS writes tax code to incentivize certain activities. And bonus depreciation, what was happened in Tax Cuts and Jobs Act was that we had bonus for 10, 15 years, we've always had bonus. But that was applicable to new construction or a newly acquired asset. So when somebody bought an existing building, it didn't qualify. The Tax Cuts and Jobs Act expanded the definition and allowed it to then apply to used property. And so then taxpayers began to realize that they could buy an existing commercial or residential property, and then they could do the cost segregation, and bonus depreciation applies at 100% in previous years. From 2017 to 2022, it was 100%. So 100% of that is deducted immediately in year one, and the taxpayer is offsetting, maybe all of their income with that deduction. So the ROI on the purchase of a building, all of a sudden, the game completely changes because of how much they're saving on the tax side and then converting that into a real estate investment. Because of that, it is driving specific sectors in the real estate markets that we've probably all seen shift in our local communities because specifically of bonus depreciation. One of them, certainly short-term rentals. And we can dive into that a little bit if you want, but short-term rentals is really then getting into the short-term rental loophole and dealing with passive versus active. The threshold for active participation is entirely different and much easier with short-term rentals. So we've seen a massive increase in the acquisition of those property classes. And then on the commercial side, car washes, those car washes, I don't know, what is it, Quick Quack or whatever, and wow, and those ones we see that are the drive-through type, drive up, pay at the kiosk and drive through the thing and drive out, those are considered equipment rather than commercial real estate itself. So the entire building is treated either 5, 7, or 15-year property. All of it then qualifies for bonus depreciation. You can have an investor that then goes out and buys a $2 or $3 million car wash, take out your land allocation, maybe call it 20%. The remaining is completely deductible with bonus depreciation. So someone who has a high tax liability is utilizing that for a full offset of their gross income that's reflected on the tax return, depending on their tax situation.
Right.
So car washes. Another really significant class is self-storage. I have personally invest in self-storage. It's a great class. Vertical, it does extremely well in terms of returns. Those properties are older, drive-up metal buildings, not the newer multi-level concrete, climate controlled. Those are more like standard commercial buildings. But those older style self-storage properties are really, really impactful from the depreciation standpoint. Mobile home parks are another one. See a lot of demand for mobile home parks because it's mostly land improvements, again, mostly deductible. And then other ones are freestanding restaurants. The IRS has a special depreciation rule for freestanding restaurants, like fast food restaurants. And they also are treated as 15-year property. And so the entire property can then be deductible. So those are some of the verticals we've seen because of bonus depreciation. A lot of investors are pursuing those directly for the tax benefits. And then aside from that, the standard asset classes still perform incredibly well. Multifamily properties, multifamily value add properties, buying older properties, massive value add, which then has a whole nother aspect. I mean, then we really dig in deep with writing off all the things you're demoing and you're taking out when you do a renovation. The write-offs on those are huge. So it just goes across the board. There's not a property class we don't touch with the cost seg study.
Yeah, I know that, and I've seen some gas stations, convenience stores. I believe that's a lot of 15-year asset class. It really runs across the gamut of all these asset classes that could be beneficial. Now, we'll talk about timing in just in a few minutes. So obviously we understand what a cost segregation study is. let's talk about the typical taxpayer that's going to benefit the most from it, which I look at it as you've got different buckets of people, right? You're going to have one, your real estate professional status person. Two, your short-term rental property operator that manages their own short-term rental property. Three, you've got your business owner that potentially buys an operating facility for their business. Let's say you own a veterinarian clinic and instead of renting, you build a clinic. And then four, you have people that have passive income that just want to offset that income. They don't necessarily need to offset other active income, so they're passive investors, but they like that immediate deduction to be used now or in the near future. In that category, I think is very underrated. I feel like, you've got, let's say you have a passive investor and someone buys a property, and let's say they're a high, I'll give you an example of, let's say it's a medical doctor, and they buy a $400,000 single family home, and they're in the 40% marginal tax rate. Let's just say what state and federal. Well, if I told someone that, hey, you're going to buy a property, you're going to get an 8% return, and it's going to be tax-free for the next 10 years, that's very attractive. So even though they do the cost segregation study, let's say a passive investor, and they get this big deduction today, being able to use that over the next 8 to 10 years could be very attractive.
You know what? I love that you brought that up, because we do actually have a number of CPAs and tax professionals who still will look at the opportunity, we'll run a proposal for a client, they'll take it back to their CPA for review, and then the comments are, well, it's all passive, it's not going to offset your W-2 active income because you're a passive investor, there's no value to doing cost segregation. And there are some cases where that may be true. If their standard deduction is already offsetting all of or any passive income that they have, they may not need to utilize the cost segregation and accelerated depreciation. However, most of the investors I know, they don't just have one property. They have multiple properties. They typically have other investments. They have other things that they are doing. And a lot of times they tend to be moving things. So they've bought something and then in a tax year, they're selling something. That sale is then creating capital gain. It's creating a taxable event. What a lot of people are neglecting to think about when we look at utilizing the study, even in a passive setting, is that depreciation, you don't lose it if you can't use it immediately. It becomes a bucket, or there's a few different ways to phrase it. It can be a net operating loss or carry forward loss. It can also be called a suspended loss. So we have this sort of suspended loss that's hovering out here. It's essentially waiting to just jump in and offset some income when it occurs. So when that taxpayer sells an asset or they have some other gain type of a situation on their return, that is going to offset that, and they'll be able to use that depreciation. So they just create this sort of bucket of deductions they're always able to pull from. And to your point, offsetting any of that rental income or other rental income potentially from other properties that they can utilize that for.
Right. I mean, a lot of times there's different terms for this, but let's say a 1031 exchange doesn't work for you and you're selling a property. Even if you're a passive investor, this could be used to offset a lot of that gain from the sale, instead of kind of getting into a 1031 exchange if you don't want to be in the 1031 exchange, if that makes sense. If they're both passive activities.
Yeah.
So that's the one that is always, I mean, when I think about someone that's in that marginal tax rate and they're saying 8%, in my example, that's an attractive 8% tax-free is pretty darn good.
Well,
probably the biggest impact, though, immediately would be someone that's a real estate professional status. And I know we talk about, we really haven't talked about that much in this pod, in the Mr. R show, but a taxpayer that's we call rep status, right? Real estate professional status is going to be someone that in general meets the 750-hour mark, meaning you're in real estate trades or businesses for at least 750 hours for the year, and it makes up more than 50% of your professional time. And if you're if you're a real estate professional, then what happens is real estate investing in rental properties is you I don't want to say you skirt the rules, but it's not considered a passive activity anymore.
Right.
And for those people, so if you have those people on your book of business and you're preparing tax returns for those folks and they own rental properties, this cost segregation study is a juicy opportunity for them. So
yeah, yep. Well, if you'll humor me for a second, I'll tell you a story. California, we love California.
Oh yes,
some of these poor successful people in California can be under the pains of significant tax liability. I had a situation with a gentleman I was chatting with. He's an attorney. He's doing very, very well, making well over 7 figures a year. And they were at a 52% tax rate. So just imagine, he's paying a lot in income taxes, federal, state, and the other things that get tacked on and in that area. He had 7 investment properties. I think 5 were short-term rentals and 2 other kind of commercial buildings or something. He had never looked at cost seg. It was all passive is the way it was currently situated. His CPA had not mentioned the strategy at all. We started to dig into it a little bit, and I said, we ran the numbers on his properties, and I said, this is going to generate, if we do the cost seg on your 7 properties, it's $1.4 million of depreciation for this year, this tax year. It would literally put $600,000 of cash back in his pocket to just simply take and buy another property. There's a down payment for the next property and just continue to roll. The issue is he's got a W-2 from his law firm, and it's passive activity. So I asked him, I said, well, are you married? And he says, yeah. And I said, okay, what does your spouse do? And he says, well, she's a teacher. He says, but actually, she's just a part-time teacher. She just likes to volunteer and do substitute teaching from time to time. Not very much. And I was like, okay. So how much did she make last year? And he said, she made $30,000 last year. And I said, and how involved is she in the real estate? And he said, quite involved. She manages a few of the property, but she's interested in doing more. Okay, beautiful. Great situation. So here's the deal. Her making $30,000 a year is costing you $600,000 this year. So how about she drops the substitute teaching job? She can go volunteer at the school whenever she wants and don't get paid for it because it will save you $500,000. She can become a real estate professional. She can manage the properties, utilize it, convert it into active activity, and there you go. Continue to build your portfolio. They were flabbergasted at the potential upside, with one simple action that they were not far from. Now, obviously, not everyone can do that, but we are dealing with taxpayers on a regular basis who want to shift more into real estate investing and building passive income. And they're open to these ideas. Some of them are looking at ways to actually get out of their day job. I chatted with another guy he's actually in software. So he's a software developer. He works for a big tech firm in San Francisco. He's making lots of money. He's doing great. And he hates his job. And he was like, I'm so burnt out. I'm so done with it. I don't want to do this anymore. I'm starting to buy real estate. I really want to be able to now take all the stuff I've been able to earn and take my portfolio and start to invest. And what does this look like? And I think this is such a huge opportunity for tax preparers to really understand how to have the conversation with their clients and help them decide what are they looking to accomplish in their life and professionally, because this is really a tremendous strategy for helping people in this situation be able to look at opportunities to change their life. And it sounds, sometimes I'm like, okay, it sounds a little cheesy. But to be honest, I have worked with clients who are in that situation and have built their portfolios and changed their lives. And I think it's amazing.
Well, absolutely. And that's something to remember when you're looking at your client's tax returns. And we're going to get into timing a little bit in a minute. You made a great point. That case that you're working on from California, even though the spouse was not rep status the year they put the asset into service, the rep status is a year-by-year test. So if she wants to take 2024 or 2025 and pour into real estate and give it a real chance and be a real estate professional status that year and benefit by $600,000, and then in 2026, a year later, she's just like, this isn't for me, I want to go back to teaching, that's okay. It's not like you have to prove rep status every year. It's a snapshot of that given year. And for someone that my wife's a teacher, so they put a lot of work in for not as much compensation as they deserve. But for this lady it would take her 20 years to make as much money as she can make by being a rep status for 1 year.
Exactly.
And, that's that. And it's nice because she could really plan on it. And in that case, who knows what this, I love pairing cost segregation studies with other strategies, but like for the tech guy, I mean, if he's paying over 50% tax, I'm guessing, he's making over $600,000. But what happens if what if they acquire a couple of properties and their cost segregation studies actually are more than their income? You've got a couple options. The option I like the best is just to do a Roth conversion tax-free. The other option you have is you don't have to take, this happens, I find it, Heidi, with some of the short-term rental operators, because some of these folks are in that range of, let's say, $200,000 to $300,000 of W-2 wages. They buy maybe a $800,000-$900,000 property, and the cost segregation study comes in so high that it wipes out all their W-2 wages, which seems great, but you really don't want to be not using your standard deduction and using that 12% marginal tax rate and not taking advantage of your child tax credit. So sometimes it's almost like, hey, we only needed one run, but we hit a grand slam and we got 4 runs. Great, I'm not going to complain. But in that case, you could always pair it with the Roth conversion, or if the cost segregation study comes in after the end of the year, so it's too late to go back to do the Roth conversion, you don't have to take bonus depreciation on all asset class levels. In other words, we've, on our client bases, several times said, man, this cost seg came in so well. ETS did too good of a job, I guess, and I'm going to elect out of bonus depreciation for the 5-year asset class, and I'm going to take it on the 7 and 15, and now that client has even additional deductions for the next few years. So really gives you a lot of opportunity, even if that deduction comes in really high.
Yeah, it is a great point, because some taxpayers get a little bit nervous when they're doing a cost seg. They run the numbers and they're like, wow, my tax return shows I have a negative $475,000. It's like like a huge, massive negative number on their return. And I'm like, that can't be good. This is going to make the IRS take a double, do a double take. Now, I would caveat this, that we have not seen much scrutiny with the IRS. Cost segregation is not a heavily audited item. In fact, it has automatic consent, it has automatic approval, and prior consent for Form 3115. It's something, again, it's a preferable method for depreciation. So it's quite common now that we're seeing losses with people who have real estate, because, this is how real estate works. But to your point, there are not very many tax preparers or individuals that are aware of the fact of exactly what you said. You don't have to actually take the full bonus. The other issue, I actually don't know what it is right now. We're at 60% bonus depreciation right now. We do expect it will be extended sometime early next year, hopefully back to 100%. But when it was 100% before, you could elect to claim 50% bonus and then take the remaining 50% over the 5, 7, 15-year class lives. So still a lot of accelerated benefits. You could, to your point, elect out of bonus altogether and just simply take the accelerated 5-year property, still really significant tax benefits. And you could do it what Chris was suggesting, choose by asset class and apply bonus to 5-year and not to the other ones. So there are a lot of workarounds or strategies for how to best apply this in a situation that's going to work for that particular taxpayer.
Absolutely, because it's a case-by-case situation. And we don't know what's going to happen with bonus depreciation. We can touch on that in a minute. I do have a question for you, just because I was just thinking, we take for granted because you and I look at these all the time.
Mm-hmm.
What could, if you're working with a taxpayer and you're a tax professional, in general, what are they looking at as far as 5, 7, and 15-year asset class eligible or bonus depreciation eligible asset when it comes to a percentage of the property? So let's say, I know it depends on type of property, but let's say someone buys a commercial building for $1 million. Let's say that 20%'s land, just what if, obviously it depends, and you've got $800,000 worth of building asset. What's the range typically that you're going to see that's eligible for bonus depreciation?
Yeah, that's a good question. So in that scenario, let's say we've got $1 million purchase. We're allocating $200,000 to land. That gives us a tax basis of $800,000. We'll call this an office building. So we've got some office build out, maybe multiple tenants in a larger property. At $800,000, we're probably going to pull, kind of depends, but probably between 25 and 30 plus percent. So let's just conservatively say it's 27%. That equates to about $216,000 that drops into 5 and 15-year categories. 5-year being personal property, so interior finishes and fixtures. 15-year property is outside exterior land improvements, so parking lots, landscaping, signage, lighting, anything outside the building. So combined $216,000. When we have 100% bonus depreciation, that results, $1 million purchase is a $216,000 depreciation year one. Then just depending on what bonus depreciation is for the given year. So it's kind of a ballpark for that type of property.
Right. No, that's good. I've been using just a rule of thumb, 25% is eligible for the bonus depreciation. Usually they come in a little higher. Obviously, there are a lot of factors involved. So
yes.
So we talked about rep status people as really the lowest hanging fruit if you're thinking about your tax book of business. Short-term rental property operators. I touched on that a little bit, but there's some concept, if you haven't heard of it, called, I don't know if I love this term, I like it, short-term rental property strategy. Some people call it's commonly referred to as a loophole. And ultimately, if you have someone that is operating their own short-term rental property, so from a technical perspective, they have what's called material participation in the property, and the property qualifies as a short-term rental property. In general, it's average stay of 7 days or less. There's a rare exception of 30 days or less if you have substantial services, which is like 1% of the time. Especially for people, as you know, like a lot of the people in California might buy something in Scottsdale, Arizona, or in Lake Tahoe, or in the, we even have operators in the Smoky Mountains and that sort of stuff. So if they're operating their own short-term rental property, a separate set of rules comes into play where that property is not considered, it's considered non-passive, and it's considered a commercial property.
Yep.
So it used to be, like I said, it had to be $1 million property or more. Assuming that they purchased the property before 2022 at the 100% bonus depreciation, what are you seeing as the price point is where it might make sense for them to look at a cost segregation study on a short-term rental?
Yeah. It's a great question. On the short-term rentals, to your point, now all of a sudden it makes so much sense to do cost seg, whereas 4 or 5 years ago, we just didn't see it applied near as often. But, pricing is more reasonable. Bonus depreciation, of course, is creating such a big immediate tax benefit. We are doing cost segregation on everything from $150,000 properties up to $1 million and everything in between. I mean, it's really looking at the taxpayer's income, what their effective tax rate is, and how much they can really use. So we like to look at it. Again, if we go back to the same percentages we were discussing on the commercial property example, maybe we're going to pull about 25%. Typically, we're going to be between 25-30% on a single family home. So let's call it 25% pulls into personal property. If that's the case, again, if $100,000 basis, that's going to pull them, $25,000 deduction. That doesn't seem like much. Some taxpayers I work with are really high end, and they're like, well, based on my effective tax rate, who cares about that? But I work with some taxpayers also who are like, hey, this is going to save me $8,000 or $9,000. Done. Absolutely.
Right.
That's cash in their pocket to, make some improvements or do some things in the home. So in those situations, what we do is we have a very detailed benefit analysis, even on smaller properties. And some people will say, well, I don't know if it's worth it. And I don't know if it makes sense. So look, it's easy enough for us to look at the details of the property and get you an estimate. Not so much because then you feel obligated to me. You know what, honestly, I want what's best for the taxpayer. So let's run the numbers so they can make an educated decision and really understand if it's going to make sense. We run the depreciation estimates, the projections, and then the CPA, ideally, your tax preparer can take that information and plug it into their sort of projected income and what the tax year is looking like, and really see what is the bottom line difference that it's going to mean for this particular client.
Right. And that's the thing, is when you're working with a third party that is very reputable, like an engineer tax service, and you're a tax professional, I think a lot of tax professionals are reluctant to do the cost seg because they're afraid, like, they have to figure all this stuff out. No. They give you the depreciation schedule. You just put that and take that and put it in your tax preparation software.
Yeah.
Which is a good segue to what I love to find properties that were purchased in previous years that you can do cost segregation studies on. And that's something to remember, that we talked about that rep status or that short-term rental loophole qualification. Those are annual, those are, or if you sold a rental property and you're 100% passive, those are year-to-year analysis. There are several times we look at a tax return. Heidi, I know you and I have looked at some mutual clients' tax returns where they've purchased property over the last 5 years and had no clue what a cost segregation study is. Not that their tax professional was bad. The tax professional was more of a generalist and just didn't work in real estate field. And we can go, and even if they didn't have the rep status when they bought the property, or operate the short-term rental property when they bought the property or placed it in a service, but they're doing it now, you could actually go and run a cost segregation study for 2023 or 2024, depending, if you're on an extension, even if you bought that property in 2021. That just floors me, but that is a huge value add. And can you kind of talk about what we should be looking for as tax professionals in that case?
Yeah. Oh, absolutely. That's one of the beautiful things I mentioned, that the IRS has provided prior consent and automatic approval for a Form 3115. That is a change of accounting method. It is prior approval. It's consent because it's a timing difference. And so the IRS, they allow those to be filed. It's something that allows for us to apply cost segregation, change the depreciation method on any asset at any time. So it's not subject to the 3-year look-back rule. It doesn't require amending prior returns. It's really just identifying that there's a property that the depreciation can be optimized and the taxpayer chooses to use the make-versus depreciation versus straight line. And so we calculate the difference. And to your point, I appreciate you saying that it can be a little bit scary for CPAs who haven't been through the process, because they're like, well, okay, fine, my client does this, but then what do I do? I don't know what to do with this. We do have all of the updated or revised depreciation schedules in our studies. We also will do the Form 3115, so we can do the calculations. So making the change is a very easy process on the tax preparation side, that can be applied on any of those kind of retroactive projects. What you should be looking for as a tax preparer, if you see a depreciation schedule with an asset that's 100, 200, 300 plus thousand basis, and it says building straight line 39 year, or building straight line 27 and a half year, it should be looked at. Now, within reason, I usually say about 10 years back. I mean, beyond, especially if it's a single family, rental property, depreciating over 27 and a half years. If it's older than 10 years, they've already depreciated over half of the asset or close to. So we're usually saying, look, somewhere in the last 10 years, if you see an asset, not only just the building, but also the improvements. That's what I see all the time. It's like, here's the building, here's the land, here's improvements. Building, $860,000, straight line 39 year. Improvement, $672,000, straight line 39 year. Like, it is a shame that that is on that taxpayer's tax return, because the opportunity that lies in those, the purchase and the improvements that are sitting on that depreciation schedule is tremendous. And for a taxpayer to catch that, it's a matter of looking at it going, oh, we should take a look at this one. Get a proposal. You save your client a couple $100,000, and I can tell you who's going to be their biggest hero.
You are. I mean, you have a client.
Oh gosh, my CPA is amazing.
Yeah, where would they be without you? You know, and I would argue, it's such low-hanging fruit. And if you don't be afraid of this, I mean, like I said, you'll get a report as a tax professional with a 3115 adjustment, and it is weird. The first time you see a property with like a minus $300,000 on a Schedule E, you're kind of like, oh boy. But ultimately, we talk, in our practice a lot that tax laws are written to encourage and discourage certain behavior, and the IRS really sets the blueprint out for us of what's what's encouraged and what's discouraged. And the fact that the IRS gives you an automatic approval to change your accounting method instead of applying for it, they've seen enough that they said, yeah, we're not making up phantom deductions. All we're doing is properly allocating the purchase of the property to the proper asset classes. That's it. And it's something that you should really consider for your clients. So, and not only are you adding value to the clients, on the cost segregation study, once you start working with a specialty firm, because I've been doing this for over 20 years as a tax professional. I don't know enough about cost segregation studies, research and development credits, and some of these other specialty tax services. And I know we were lucky enough to have Julio from ETS on a previous podcast talking about specialty tax services. So check that out and get your free CPE if you missed that one. But there are so many things that a specialty tax firm can uncover even during a cost segregation study. I know, Heidi, for us, we had a client that was doing a cost segregation study, and you uncovered the 45L and the 179D deductions and tax benefits that I didn't even think of in this project. So can you kind of, maybe, I know there's a cost segregation study episode, but sometimes you guys discover some other things within a building or a project that could benefit a taxpayer.
Yeah, absolutely. And that's one of the things where, we're not just a cost seg firm. We are an incentives-based specialty tax provider. So we have a number of different tax credits, deductions, and incentives that we're always trying to strategically identify and assist clients with wherever we see an opportunity. Two of those that directly relate to real estate are the 45L tax credit and the 179D deduction. And both of those relate to real estate. They're both for energy efficient buildings. We see them most applicable when it's either new construction, so someone's actually building something ground up. There is some application for renovations, but a little bit harder to get those to apply on the renovation side. So for tax preparers who have someone who is building a home or building a building, a multifamily building, an office building, whatever it may be, we always look at that. If we see it's new construction, we're also going to give them information that they may qualify for additional tax deductions or credits for that particular building in addition or over and above the cost segregation value. The 179D is a deduction that is for any type of commercial building. And it starts at 50 cents a square foot and goes all the way up to $5 per square foot. I have a client I just spoke to today, just built a 18,000 square foot retail little strip center. And that will qualify for 179D at the $5 per square foot. And so it's a great, I think, what is that, a $90,000, $60,000 deduction? 90. And, great additional deduction first year that he's able to tack on to the benefits of the cost segregation. The 45L credit is very specific to housing. So that's multifamily, apartments, condominiums. We're looking at that on either individual or multifamily units. And it's a tax credit that's anywhere from $500 up to $5,000 per unit on any of those projects if they meet the energy efficiency requirements. And so as an engineering firm, we do the energy modeling and the certification on those. There's also a specific tax form for 179D, so similar to cost seg. We perform the analysis. We actually complete this tax form that is required for that. And then that goes back to the CPA. So it makes it much easier to be able to apply that and roll it into the overall tax package.
Heck, Heidi, I feel like I need to reintroduce myself. I've been sitting here in silence the whole time. And you know what's funny about these episodes and these topics, right, is I go through more sticky notes. So let me, for anybody that might see this, it's like I'm like making it rain sticky notes here with just ideas. Here they come. Look at that. I got like 12 of them. So I say this from the, the peanut gallery, as I say now. So everything you guys have talked about, right? Something kind of a reoccurring comment comes up is somebody didn't know, or, there's this opportunity that's just kind of lingering out there. Again, that some people may think is too good to be true is almost the way it sounds. They don't know it exists, or the tax pro might know it exists, knows it exists, but they really don't know the next steps to take.
Yeah.
And Chris, it was either you earlier on, and Heidi, I think you said it too, is, really by offering this and being confident in offering cost seg specifically, it's such a bonus, right? It's a value add, it's a service add, it's doing right by your client. Where how does somebody actually almost, call it take the next steps, but like, how do you guys work a little bit more direct, if we can expand on that just for a couple moments, with a tax pro, like with a CPA? I know we talked about it a little bit, and Chris, I know you have extensive experience working with Heidi, directly in their firm, but like, what does that relationship really look like when you guys are I wouldn't say you're quote unquote the back office really of doing this, but like, what is that relationship what's the outline of it? How does it look and feel?
Yeah. I mean, I like to look at it as a partnership. We have clients ask us all the time, where do we come into this? I liken it to the medical space. Like, we're the specialist. If you need a knee replacement, you don't want your family practice doctor to replace your knee. I promise. Go find your orthopedic specialist, and then you can go back to your family practice guide for your follow-up and, make sure everything's good with your overall health. That is the same situation. We want to work in collaboration with our CPA partners and clients to be able to make sure they're getting taken care of at the highest level. We do have an amazing, fantastic kind of referral partnership program, an affiliate program. And we've recently launched a platform that we're excited about, where our partners can actually make introductions. We can work on looking at a proposal, and then they always have the ability to log into that and see the status of projects. So they can see in there, oh yes, here's, John that I sent over. Oh, they're working on a cost segregation right now, and it's in the site visit planning phase. That's great. There is a revenue share component to that as well. So it can be a wonderful way for CPAs or accounting firms to be able to increase their revenue and really just expand their offering without really having to hire someone or learn all this extra expertise. And we strive to be a trusted partner at a very highly professional level, so that we can answer questions and be here to kind of help, work through those projects and those questions as they come up. So we don't want anybody to feel like they're left hanging, where they're unsure of what to do once the final report is issued, how to finish the tax return. So I personally have many calls where I'm dealing with a client, and then at the end, I'm having a private conversation with the CPA without the client, so that the CPA is saying, look, okay, what do I need to do on the filing? How does the 3115 flow in here? And we can really assist with walking through that portion as well. So our goal is really to just be a great partner with our tax preparer friends. And we have a lot of things that we've built out over the years to help support the industry.
Amazing. Yeah, thank you for describing that, because I'm sure there's some, uncomfortable or uncharted waters for some, where they're like, well, I'm about to hand this client over. What does it look like? And I know, Chris, you guys in the private practice world, you guys have done that multiple times. So,
yes. Well, thank you, Heidi, so much. I mean, I think takeaways, if you have a client in real estate and they own and buy and hold property, please look at that tax return. Reach out to either us here at MRR Institute or Heidi directly. All of our information will be in the show notes. Remember, this is the other key takeaway. The asset could have been purchased in a previous year. It doesn't, and you can still do a cost segregation study, kind of like a sub-contribution, up until the extended due date of a tax return. It does not have to get done before December 31st. And I can't tell you how many times this has saved people's behinds also.
Excellent. Well, thank you, Heidi, for joining us. This is always a pleasure having you.
Oh, you're so welcome. Thanks for having me. I love chatting with you guys, and I love your the way that you're helping the accounting space and the tax preparation world. It's what's so needed in the industry. So I always love doing projects with you.
For everybody that's listening to this, go ahead and share this episode with anybody you think may benefit from this specifically. Again, it's a topic that I know there's a lot of interest out, and while you guys are sharing that, I need to go stock up on sticky notes. So until next time, we will see everybody back here on the Mr. R Show.
You've been listening to the Mr. R Show, presented by the MRR Institute. For more content like this, be sure to check us out on YouTube for weekly expert tips. And don't forget to subscribe to this podcast to stay updated on the latest strategies for scaling and modernizing your tax practice. Looking for more? Contact us at mrrinstitute.com for practice resources, coaching opportunities, and a peer-to-peer mastermind group. Thanks for joining us, and we'll see you next time.
The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer.